If you want to lower your lifetime tax bill, you're in the right place. Welcome to Rooney & Associates TNT Tax Strategies, where we believe in paying Uncle Sam what you owe, but never leaving a tip. Today, we're discussing net unrealized appreciation, or NUA. NUA is a tax strategy that separates the cost basis of a stock from its appreciation. Public companies oftentimes allow employees to purchase the company stock within their 401ks. When these companies perform well over an employee's career, the employee can find themselves with large concentrations of highly appreciated company stock. Upon retirement, many employees roll their entire 401ks into IRAs without realizing that they may be missing out on the power of using the NUA strategy. NUA allows you to pay lower long-term capital gains rate on appreciation of your employer's stock held in a retirement plan, such as a 401k, instead of paying higher ordinary income tax rates. This strategy can lead to substantial tax savings, especially if the company stock is increased greatly in value. Here's how NUA works. Meet Cooper. He's a longtime Boeing executive who's retiring after a fruitful career. He retires with a 401k account totaling $2 million. To make up that $2 million, Cooper has the following components. He has $900,000 of Boeing stock with a cost basis of $100,000, and he has $1.1 million in other investments. Cooper is in the 37% ordinary income tax bracket and the 20% long-term capital gains tax bracket. He is very savvy with his finances and wants to execute an NUA transfer of his Boeing stock. To transact the NUA transfer, Cooper initiates a lump sum distribution of his 401k. He transfers the $900,000 of Boeing stock in kind into a taxable brokerage account, and he rolls the $1.1 million of other investments into his IRA. Please note, Cooper pays taxes at the time of this distribution. He pays ordinary income tax, but only on the cost basis of his Boeing stock. So that's 37% of $100,000 or $37,000. Cooper pays no tax on the IRA rollover of his $1.1 million in other investments. A year later, Cooper decides to sell all of his $900,000 worth of Boeing stock. He pays capital gains tax on the NUA, which is 20% of the NUA of $800,000 or $160,000 in taxes. So in total, he pays $37,000 in taxes on the cost basis and $160,000 in taxes on the NUA, for a total of $197,000 in taxes. Now, let's compare the NUA situation to the case where Cooper rolls over his entire 401k balance into an IRA, instead of transferring in kind his Boeing stock into a taxable brokerage account. If Cooper were to transfer his entire 401k into an IRA, he would not pay any taxes at the time of the rollover. 1 year later, he begins taking distributions from the IRA, and he sells all of his $900,000 of Boeing stock. All distributions are taxed at his ordinary income tax rate, which is 37%. If he withdraws the full $900,000 in 1 year, he would be taxed 37% of $900,000 or $333,000. In this example, without using NUA, Cooper's total tax bill would be $333,000, whereas if he used the NUA strategy, he'd pay $197,000 in total taxes. He would save $136,000 in taxes by using NUA versus rolling all of his assets into a traditional IRA. By using the NUA strategy, you could save thousands of dollars in taxes over your lifetime. If you want more tips on lowering your lifetime tax bill, be sure to check out our website at raawealth.com. I'm a CPA and certified financial planner. My name is Tyler Peterson.